Through the end of September in 2022, the S&P 500 is down nearly 24%. Retirees are asking the question, when will the stock market recover? Today we'll address what you should be prepared for. Hey there, it's Anthony and Alex from One Degree Advisors. If you're new here, we're certified financial planners. We help folks with all things retirement, tax, investments. So Alex, today we're going to dig in and we're going to talk about, is the stock market going to recover soon?
Yeah, I don't know, we don't know, and anyone who states that they know with certainty when this market will, recover, I think should be viewed with an eye of caution. Now, to understand where we are possibly going to go from here, I think it's helpful to really be like a student of market history. Yeah. And, there's a lot of history we can go into. Today, we're going to keep it relatively simple. We're just going to look at 3 previous market declines. But people should make sure to stick around towards the end because we'll be talking about some helpful resources which may help during times like this. But here's the thing. People typically are anchored to 2 extremes. Right? You have your V-shaped recovery, a really sharp drop with a really quick rebound, or like this world-ending economic crisis.
Yeah, it can only be one of the 2, right?
Exactly. There's no in-between. It's one of those 2. But let's take a look at an example of each of these. So we'll pull this chart up on the screen. What folks are looking at here is a chart from March of 2020. And this was the COVID drop, right? So the stock market dropped over 30%, but here's the thing, it was one of the fastest market recoveries in history. So the S&P 500 took 33 days to reach the bottom, just about a month.
A third of the market dropped, gone.
But here's the thing, is it only took 140 days to recoup its losses. So the recovery from the March lows was astonishing, and you were up over 65% by the end of the year from that March.
From the
bottom part. Right. And so that's the thing. That's our most recent experience with a big kind of bear market. The problem is it was so fast. And so some people are getting anchored to that. That's what they're used to. That's what they're expecting. So anything longer than 30 days down and 140 days up, they're like, what's going on here? Right. Now, over a decade ago, we had the Great Financial Crisis. So this is kind of more like the world-ending, economic crisis end. The market dropped over 55%, which is really bad. But here's the thing. It declined for over a year. So literally for a year, the market was in decline. It was
close to a year and a half, really.
And then it took a little over 3 years to recover. Yeah. That can take a heavy toll on someone. Not just an average investor, but especially a retiree that's looking at their portfolio to create some income. And of course, this is an extreme example with bank collapses and an overall economic failing. Right. One last chart we'll pull up here. This was the Dotcom Bubble of the early 2000s. Now, in this example, for the S&P 500 total return, it took about 2 years to bottom and about 4 years to recover. Okay, and you can see that maximum drawdown shown on the chart was about 47%. Now, here's the thing. In all of these different crises, you could de-risk your portfolio in a way and lower your downside by including some more conservative investments such as bonds or treasury bonds. But here's the difficult part is, as we've discussed in past videos, bonds really aren't working this year, right? Bonds are on pace for one of their worst years in decades. So this year's presenting a big challenge for investors, especially retirees that have bonds in their portfolio, because bonds are just not giving people what they expect them
It's
to.
Disproportionately hitting retirees who tend to have more bonds.
Exactly.
Now, here's the other thing, is that a lot of times people, when you talk about anchoring, they anchor onto, well, what are the averages for the stock market? And so a lot of people know that number. It's like 10% if you go back to the 20s. And DFA has a nice chart where they put all the yearly returns in order. The thing is that when you look at 10% returns, it takes a long time to get there in terms of the averages. Yep. There was only, in the past 96 years, only 7 years where it was actually near that 10% range to actually get there. Things take a lot of time to average out where we get that, that quote unquote normal return.
Yeah. Now, the thing is when we look at all this, right? So some people might be like, well, yeah, I know 10% is the long-term average, but right now things really stink. And so we're not minimizing the losses that many retirees are facing because the truth is that retirees are losing serious dollars at the moment. Right. These losses are scary, and the thing is they could potentially wipe out a retiree who is unprepared. I think that's the big key there.
Right.
Is if you're unprepared, this could be a wipeout scenario for you.
So, and when we're talking about preparation, we had posted a blog article in early 2021. So this is when the market was really good, and it was all about preparing for the next bear market. At the time that we posted that, and I think it even says it in there, we're not necessarily predicting when that's going to happen. We don't know what that's going to look like, but it was really mapping out a plan for how to prepare for the next bear market. Now that we're in it, many of those principles still apply. And it's a good way to not only maybe make some corrections, but to look out and say, okay, how can I be prepared for the next one? Because that'll happen as well.
Yeah, I mean, you need a plan to weather the storm. So for a lot of our clients, allocations to short-term bonds, short-term inflation protected bonds. Those are the things where they are helping so far this year on a relative basis. The other thing is more kind of like a trend following tactical strategy, which a lot of our clients have. That's helped because right now it's very defensive, and it's been quite defensive for most of the year. So it's in those short-term treasuries. Point being is that this isn't an adjustment that you can make like mid-year, or you probably shouldn't, right? You need to have planned this out years in advance, kind of like you were talking about earlier, preparing for the next bear market in advance. You don't want to be doing this last minute. One final thing here, we did recently publish a video for retirees called 3 Ways to Protect Your Retirement in 2022. People can watch that right here. Again, something good to check out.
What are you doing to prepare for this market? Whether we continue to decline or we hit a rebound? Leave your thoughts in the comments down below, along with comments for any future videos. And if you like today's video, please like and subscribe for more. Thanks for watching.